Hey folks, welcome back to Gaming Garbage Road. Take a look at games, chat about the gaming news in the industry, and of course, stream for fun. This is going to be a shorter one. This is going to be on Ubisoft. So we had a earnings call in May. It is a little bit ago, but I was actually taking time to read this, and there was a few things that I really want to point out, and then I'll correlate it with some of the information that we have on the stock side. And man, I still don't think things are really overly that good. Now I will link this uh, from Market Screener, excuse me, as I have hiccups that so that you can read this yourself. But there's a few things here that I think are really interesting with what they're saying about what's going on. So um, some of this too has to do with the new subsidiary, which, by the way, they just nominated one of the two people that will help oversee the new subsidiary of Ubisoft that Tencent pumped into 1.25 billion US dollars. And yeah, it's going to be Guillaume's son. So hey, that's great. I mean, we're not getting very far from the tree, are we? But yeah, a couple things I wanted to highlight here. And this is in response to how much that Ubisoft is thinking that the new subsidiary is actually going to make. And it's going to be made up of Rainbow Six, Assassin's Creed, and Far Cry. And the question is, yes, you responded to three, maybe my last follow. On the new subsidiary, can you give us the idea of profitability in a full year of 2025? Do you think it'll be like 25 or 30%? Would that be the ballpark? And the financial officer says, well, what we can say is that over the last 3 years, our three brands had good profitability and good cash generation. That's what we can say. So like, that's incredibly bland because, again, they know that the cash injection from Tencent is huge. I'm sure Ubisoft also had some cash injection of their own because, again, Tencent only put in $1.25 billion, and that's only like 25%. So the other 75% had to come from somewhere else. And the majority of that is probably from Ubisoft itself, or at least to a degree. And then this I thought too was interesting. You know, the question is, I'm wondering if you could just give us an idea of what the net operating income and free cash flow would be qualitatively, excluding the restructuring costs, and then in terms of significant content that's coming out in 27 and in 28, is there anything you can say by way of quantum, which year is going to be greater than the other? Because from this point on, the financial officer has been very kind of dancing around the rose bush or even just blatantly saying, no, I can't really answer that. And the games that you're investing in, and in terms of time, are you delaying those by a matter of months or is it a matter of years? Because they've said too that they're delaying at least a couple of projects. And then finally, what are the sort of hurdle rates that Assassin's Creed Shadows has crossed in terms of its units sold? Yes, to the first element, we don't just close that element. What we say is looking forward to the past 2 years is that fiscal 24 and fiscal 25 accumulated, we've had around 25 million euros of restructuring costs. So that to give you an order of magnitude, in terms of content, to come in 27 and 28, yes, as we mentioned with Yves mentioned that this will be strong content coming on our largest franchise. So that really reflects what we quote, shift and focus that we announced two years ago. You should expect strong content from our franchises. As you know, we mentioned Assassin's Creed, Far Cry, and Rainbow Six. Also, The Division and Ghost Recon were part of our 5 biggest ones. So those 3 are going with the subsidiary, and The Division and Ghost Recon are going to be sticking with the main Ubisoft umbrella. In terms of the product roadmap overview that we conducted as part of execution review, that happened over October and December. As you know, it led us to give a few more months to Assassin's Creed Shadows, and it's been a good decision to deliver a really strong quality. So we've been moving some products to fiscal 27 and to year 28. That's what we can say. And on this topic, on Assassin's Creed Shadows, we don't just close units sold. What we can say is that in accumulated player count terms, it's been higher so far than Assassin's Creed Shadows or Assassin's Creed Odyssey. And I wanted to take a look at this here. This is from Push Square, and there's a few others as well. But like, apparently we've had over 5 million players now that have actually played. And again, they won't give units sold because I imagine it's actually not that high, or at least as high as they would like it to be. Now, looking at I didn't pull this up, but looking at the budget costs and marketing, we're probably looking at around 200 million or maybe $250 million for Assassin's Creed Shadows. And so, yeah, it's possible now that they've actually made some profit and have at least covered the cost. But again, Shadows hasn't covered the cost that they've lost on X Defiant or Star Wars Outlaws or some of the other projects like even Skull and Bones. Even though Skull and Bones is running for its second year now, we haven't heard of really year 3 or a year 4 yet. So we're not entirely sure if there's going to be continued support. Probably to a degree, but again, when it really doesn't make enough money, they'll probably just can the project. Let's see. Oh yeah, he has to follow up. Could you give us an idea of the phasing of the negative cash burn that you're expecting over the course of 26? And he just said, we don't disclose this element and for now. So they might later, again, if it's good. But yeah, they're expecting some serious cash burn, which is kind of insane. And this one I really want to go over. I've got 3 questions as well. One, can I push you a bit harder on the numbers of negative free cash flow in 26? Should you think it'd be above or below minus 1 million euros? 2, can you walk us through the group's transition of positive free cash flow for 27 and beyond? And should we expect this to be more of a top line or cost-based story? And then 3, can you remind us of your debt obligations over the next 3 financial years, including any convertible bonds with put positions? Now, what that is that people take positions against the stock. And as you can see, if you've had puts, you've probably been making some money because, yeah, we're down at like, $10, $11 now pretty consistently. It's just kind of been in this range. And it's been really, really bad. And I want to say, too, this is basically when Shadows launched right here, is that, hey, it was looking pretty good. Had a pretty good bump, okay, up to about $15 from 11 to 12. So, yeah, it was a pretty good bump in stock there. And then we had Shadows, and you can just see the fall off. So, in my opinion, Shadows still didn't do well. And if people even just paid for the online subscription service, well, that's only $18, not $70. And that's a big difference there. So let's go back to this. They say that for the fiscal year 26, yes, free cash flow consumption should be above 100 million euro, and including the restructuring cost impact, which we got to see was about 25 million, or at least for this year. So yeah, they're going to be spreading that out over next year and probably also through 27. In terms of the fiscal year 27, yes, we expect cash flow to come back to be positive with robust generation in fiscal year 28. So it'll finally be positive, and then it should be quite a bit positive in 28. And that will be in a combination of top-of-the-line growth and cost-based reduction on the back of our extension of our program. In terms of our debt maturities, this is crazy. So we have 2025, which is around 275 million euros across term loans and whatever that is. I can't pronounce that. And if put options of convertible bonds was to be exercised, that would be around a bit more than 500 million euros in 26 and also 700 million in 27. Oh my word. That is a ton of money. And that's just having to pay people with them turning in their puts. Again, betting against the stock, again, which has been very, very profitable. And that cashing in those puts is going to affect their stock and their revenues to a degree at the end of the day. And that is a massive amount of money. So yeah, they have some loans that they have to deal with, and when we take a look at what their net income is, I want this a little bigger. There. When we take a look at what their net income is, it's never been very high. 4%, 3%, negative 27. That was a really bad year. About 7%, and then about negative 8. And again, this is all of 2024. Each one of these is a year. And when we take a look at financials, it just continues to paint an ugly picture that doesn't really seem to be getting better. So their earnings per share is a negative $1.38, which means they should be paying you for owning shares, basically. And then there's still a massive amount of closely held shares that aren't public. So, yeah, by the investors, like with just the people that we just read with their questions. And then, yeah, when we take a look at how much actual debt they have $2.3 billion. Like, I mean, dang, that is so much freaking money. Cash and equivalents, I guess, is pretty high at $1 billion. That's good. But yeah, their debt is huge. And they have a massive re-upping of debt or put options that they have to deal with. And that's significantly going to dig into some of that stuff. So yeah, that's not going to be, good effects on their stock or anything else. They also don't even share a price per earnings anymore, just price per share. Because again, it's not, they quit covering it in 21 because again, it was just kept going down. And then when we take a look at their earnings, this is their 6-month forecast, and their earnings per share is just all over the place. And then their revenue, it's not very leveled out either. It's still positive, that's what their forecast is. But when we take a look at their annual, it's starting to raise up a little bit, but then it caps out again in 27. And that's when they're actually supposed to be like making the positive cash flow for these investors. And they're expecting more even in 2028, even though it goes down a little bit. So, I mean, are they, even though they're expecting better profitability, why isn't their revenue actually going up? Are they just becoming more efficient? There was something too in this. It'd be tough to find at this point. But they also said that they plan on reducing by another 100 million on their expenditures or their like operating costs, which is basically like firing some more people. And so yeah, that's not necessarily a good thing for some of them. But yeah, realistically, like this is looking painful, and it just has not been good for some time. And I'm hoping that yeah, eventually they can figure this stuff out. But again, if they're just taking this subsidiary, getting that cash injection from Tencent of 1.25 billion US, and pushing that into their debt, and they're even saying too that they're expecting like a net zero for ultimately their costs starting in 27. So it's like they're not really looking at a ton of profitability in 25 for this year or in 26. Like that's a whole nother 2 years fiscally of really not being profitable. And so then they're really hoping to start seeing profits in 27 and then even more in 28. And we'll see if that actually happens, because again, we're looking at 28 and it's just like they're barely profitable. Like it's insane to me. And again, they have a ton of this revenue coming in, but it's just not really coming through the door like they would like. And again, they have some big releases and they have some small ones. This year was really, really good because this is when Assassin's Creed Valhalla came out and everybody was home and had some extra money due to COVID. And yeah, that game made over $1 billion, over the course of its life so far. So yeah, it's been very, very profitable. But it's been going down pretty much or stagnating for the most part. 23 was also a good year. And we'll have a fairly good year in 26 and probably a record year in 27. But again, it's just they are not necessarily doing very, very good. So, yeah, but I thought these were just interesting. Again, if you want to read all of this, you can go ahead and, take a look. And I'll link this down below. And yeah, there are some positive things. But again, the overall picture is it's not good. And if I was some of these investors like Barclays or I can't even say that. Anyway, or Bernstein and Company. Yeah, I would be kind of upset because again, these people have been investing in them for some time and they're just not seeing a return on their money. And it's just again, it's just not looking good for their stock either. I mean, just look how far this has fallen, man. Like this is crazy. Like a couple of times they were over $100, and now they're back down to 10. It's not the lowest they've ever been. But just look at this freaking stock, man. Like this is just the most bipolar stock I've ever seen. It is just insane. And the fact that it even recovered from this back in 2012 is crazy. And again, they're just crashing all over again since basically 2019, 2020. They just here we go again, just multiple years of just not making money, and their margins are awful. -8, 6, -27, 3, 4. I mean, that's their profit margin. And they're pulling in $2 billion a year. So yeah, something's drastically got to change. And something I'll say too is they still have a ton of employees. They have 17,000. They used to have 22,000, and they've basically fired a little over 3,000 employees over the last few years. But again, that's not enough because their earnings per share is still really low. They should be paying you for earning their stock. And then they still have all of that debt that is maturing that they got to pay for. And they got to pay the interest on all of that too. So, yeah, it's just not looking good. And having the son basically oversee, to a degree, the subsidiary doesn't give me a lot of confidence either. There's going to be a lot of influence there. And so, yeah, the CEO, Guillemot, is going to be looking over Ubisoft, the parent. And the son is going to be basically looking over the subsidiary of Ubisoft. And I think it's just going to continue to be the same problem. Again, the Guillemots, they don't want to lose control, but they're just running it into the freaking ground. I mean, what are you going to do? So anyway, yeah, I was reading that. I was just like, man, this is fascinating. And I don't see how 1.5 and think too, like if they're delaying some games and trying to make them better, but again, they don't even want to share how many copies they sold. That's not a lot of confidence. That means that means they didn't sell enough. Because I mean, Veilguard did the same thing, and so have a few other companies with some other games in the past. So I don't know. And if the other games don't sell, like if Far Cry 7 doesn't hit, if the Prince of Persia remake doesn't hit, the next Division game, the next Assassin's Creed, supposed to be getting another one, I guess, this year, but I mean, we haven't really heard anything about it. Maybe it came out already. I don't know. But yeah, they just have a problem. So anyway, thanks for tuning in, folks. You can always follow me too at Gaming Garbage 22 over at YouTube. We have playlists there. There's a bunch of stuff. You can just there's tons, honestly. And if you like playthroughs, there's a ton of those as well. Then you can also follow me at Twitch at Don't Tread on Thee if you'd like. And yeah, when I'm playing video games, I'll chat with y'all. So with that, folks, I'll see you guys on the next one.